Iceland's economic conundrum, a land of fire, ice, and financial tightropes. Iceland, known for its stunning landscapes and resilient people, faces a significant economic test in 2025. The nation, often celebrated for its natural beauty and unique culture, is now at a crossroads. The economy is grappling with slow GDP growth and high interest rates, complicating the fight against inflation. These economic challenges are not just numbers on a chart, they affect everyday life for Icelanders. Historically, Iceland has seen rapid booms fueled by natural resources and tourism, but these have sometimes led to sharp corrections. The country's reliance on these sectors has been a double-edged sword. The 2008 financial crisis is a reminder of these vulnerabilities. It was a period that left a lasting impact on the nation's financial landscape. Now, the challenge is a lack of strong economic expansion, with growth sputtering rather than stalling. This stagnation is a cause for concern among policymakers and citizens alike. The central bank's tight monetary policy makes borrowing expensive, affecting both individuals and businesses. High interest rates are a double-edged sword, aiming to control inflation but also stifling growth. This dual challenge impacts decisions from households to corporate strategies. Families are tightening their budgets, and businesses are reconsidering investments. We'll explore the causes of subdued GDP growth and the rationale behind high interest rates. Understanding these factors is crucial for developing effective solutions. By understanding these factors, we can consider potential solutions to steer Iceland's economy towards a sustainable trajectory. Collaboration and innovative thinking will be key. Iceland's history suggests a capacity for adaptation. The resilience of its people and the lessons from past crises offer hope for a brighter economic future. The chill of slowdown. Understanding Iceland's subdued GDP growth. In 2025, Iceland's GDP growth has cooled significantly, a departure from the post-pandemic recovery years. Global economic headwinds and a plateauing tourism sector contribute to this slowdown. Traditional sectors like fisheries face volatility, and energy-intensive industries are pausing investments. High global energy costs and cautious investors add to the economic chill. Slower growth leads to a tighter job market and cautious business investments. This creates a cycle of caution, requiring a shift in expectations. Identifying new avenues for sustainable growth is crucial. Iceland must move beyond previous growth models to regain momentum. The squeeze of high rates. Battling persistent inflation at a significant cost. Inflation erodes purchasing power, making everyday goods and services more expensive for consumers. Central banks combat this by raising interest rates, a common but often painful strategy. Iceland's central bank has maintained high rates to curb inflation, despite the economy slowing down and the potential for increased unemployment. This strategy increases borrowing costs for individuals and businesses, making it harder to finance new projects or expand operations. High rates make mortgages, loans, and credit more expensive, stifling innovation and expansion, and putting pressure on home buyers and entrepreneurs. The challenge is to balance inflation control with economic growth, ensuring that the measures taken do not stifle the economy too much. Policymakers must calibrate rates carefully to avoid a deep recession, which could have long-lasting effects. It's a delicate balancing act with significant implications for the nation's welfare, affecting families and businesses alike. The fight against inflation is necessary but comes at a short-term cost, impacting the daily lives of citizens. Iceland must navigate these challenges to ensure long-term stability and prosperity for its people. Numbers don't lie. A closer look at Iceland's key economic indicators for 2025. In this chapter, we delve into the critical metrics shaping Iceland's economic landscape. As of mid-2025, Iceland's GDP growth is near zero, with projections suggesting minimal growth. This stagnation poses significant challenges for the nation's economic stability. Inflation remains above the central bank's target, keeping interest rates high. This persistent inflation affects both consumers and businesses alike. The labor market shows signs of softening, with a slight increase in unemployment. This trend could lead to further economic difficulties if not addressed. High interest rates dampen economic activity, making borrowing expensive. This situation discourages investment and spending. These indicators tell a story of an economy under strain. Businesses and consumers alike are feeling the pressure. Near-stagnant GDP growth limits income opportunities. This stagnation affects both individual livelihoods and business profitability. Persistent inflation erodes purchasing power. Families find it increasingly difficult to afford basic necessities. High interest rates burden Icelandic families with debt. This financial strain can lead to long-term economic consequences. Understanding these metrics is crucial for effective policy responses. Policymakers need to be well informed to make decisions that will benefit the economy. Iceland must address these challenges to steer the economy towards health. Proactive measures are essential for recovery. The interplay of data points reveals the complexity of the situation. A multifaceted approach is needed to navigate these economic challenges effectively. Real-world ripples. How slow growth and high rates affect everyday Icelanders. Economic statistics translate into tangible realities for Icelanders. High interest rates have surged mortgage payments, squeezing household budgets. Young Icelanders find homeownership increasingly difficult. SMEs, the backbone of the economy, face high borrowing costs and uncertainty. Consumer spending, a major economic driver, takes a hit. Households cut back on discretionary spending, affecting businesses. This creates a feedback loop, dampening economic growth. Confidence is fragile, with economic anxiety impacting decisions. Icelanders' resilience is tested by prolonged financial pressure. The current environment affects public morale and optimism. Iceland must navigate these challenges to ensure well-being. Connecting the dots. Analyzing the interplay of economic forces shaping Iceland. Slow GDP growth and high interest rates are interconnected challenges. High rates aimed at curbing inflation, slow economic activity. This creates a dilemma for policymakers balancing inflation control and growth. External factors like global economic trends impact Iceland's economy. The krona's value affects inflation and export competitiveness. A strong krona reduces imported inflation but can hurt exporters. The central bank must consider exchange rate implications. Navigating these economic forces requires careful policy decisions. Iceland must address these challenges to ensure economic stability. Charting the course ahead. Iceland's path towards economic rejuvenation. Iceland faces sluggish growth and high interest rates to curb inflation. Key indicators show minimal GDP growth and elevated borrowing costs. The path forward requires strategic policy choices for recovery. Fiscal policy could support vulnerable households and boost productivity. Monetary policy will remain tight until inflation eases. Structural reforms are crucial for long-term resilience and growth. Diversifying the economy and fostering innovation are key objectives. Iceland's future prospects, while challenging, are hopeful. By addressing current challenges strategically, Iceland can achieve a prosperous future. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.